I've been reading every financial publication, app, and everything to scour and understand what is going on and help you to discern the difference between truth and falsehood when it comes to all the financial information, articles, and help react to it so that you can take content and put it in the context of what's actually going on as we kind of go through this. So I read an article from Markets Insider that says markets are dealing with concerns of an imminent recession in 2023. We've heard that over and over, right? That we're headed towards a recession. We've got multiple quarters of slowdown in GDP growth, which is what determines whether it's a recession or not. But there's a lot of fears because of high interest rates and because of inflation being, so high, and a slowdown in the housing market, and, a lot of, issues that are going on in the economy. So I don't have to recap all that. But this article talks about 10 reasons why investors should be owning stocks right now, according to Bank of America strategists. So first off, Bank of America strategists, do they make money by you investing? Absolutely. Bank of America has an entire investing division and, retirement planning division. And I've actually done comedy for that division before. But ultimately, it's hard when someone can get paid or has an advantage for someone investing. It's hard to see what the downsides are or what the risks might be or whether it might not be a good time. So what they say in the article is, in what feels like a conviction-less market, we have high conviction in an upside risk cyclical sectors within the S&P 500 this quarter. That's what these team of strategists said. So that comes amid growing fears of this coming downturn with inflation still well above what the Fed's target is, and interest rates at their highest level since 2007. And since this article came out, another 0.25% hike from interest rates. So yeah, the S&P 500, it had a good start in 2023. Stocks have been up, but according to the bank, there's 10 reasons why there could be upside that continues. So let's kind of look at this and see what you think. They say, number one, market sentiment is extremely bearish. So they're saying, hey, well, if it's extremely bearish, then maybe there's been an overreaction. That's what they're essentially saying. So there could be an easy shift in sentiment with just a little bit of positive news. Second, it's kind of the same thing. Recession is very expected. So it's saying similarly, people expecting a recession means that there was more downturn than what they think is necessary. Number three, they're saying, well, what if the Fed eases up on interest rates? Well, they did raise it a quarter since this came out, but they're saying if a recession's coming, the Fed has plenty of room to loosen the financial conditions after raising interest rates aggressively in the last year. So that means that businesses could borrow at a better rate or, that kind of stuff. So number four, there are trillions of dollars of dry powder on the sideline. Calling it dry powder seems kind of crazy, but they're basically saying there's a record amount of money sitting in venture capital and private equity that they could use if the market goes down to buy when they think there's a discount, which will then buffer it and send it back up. So they're counting on something that they can't predict. Number five, cyclical stocks are purged. So they're saying long-only funds, which are people that buy mutual funds that are just growth objective. There's not options trading. There's no one selling short. Maybe it's not even being heavily traded, right? They've shed their exposure, it says. And hedge funds have shed their exposure to GDP-sensitive sectors. So stuff that really we look at with the gross domestic product or the overall production of a country. And it's saying there's a lot of exposure with healthcare, utilities, and consumer staples versus other cyclical things. So they're just saying, hey, there's these other things that are set to maybe have a gain. I don't know. Then now what I'm worried about here through the rest of this article is causation versus correlation. Like they're saying, hey, look, in the past this happened, so we can kind of expect this. But is that a true indicator, or was it a coincidence? Is it a direct correlation, or is it something that's happened sometimes? What they're trying to do in this article that's frustrating is using past performance or past situations to predict future results, not considering what happens with artificial intelligence, what happens with the Fed making changes that we're here talking about in this article as well. What happens if the economy suffers or unemployment goes up or unemployment goes down, or we have all sorts of unpredictable things that can happen, like when COVID happened in 2020, or you name it. There's so many things. Like we go back to 9/11 and the impact that had on the market or the consumer confidence because of what had happened and kind of shaken us. So this is saying the Japan Factory Automation Index hit a trough. Okay, so it says that typically leads to upside for a year and a half for Japanese FA stock, strategists said. Okay, so they're then saying that's a consideration to U.S. capital goods and material stocks. It's saying the equity risk premium should fall, though some strategies have warned of potential earnings recession. If corporate earnings bottom in the fourth quarter of this year, the earnings risk premium should start to fall as investors expect more positive growth ahead. So because of this, it kind of relates to the first and second bullet points that we talked about here, that if their earnings are depressed, or they're not doing as well, that, okay, but now we think that that's kind of finished and now it's going to be positive, and that'll be exciting. Number 8, the economy will see productivity gains. So it's saying that wage inflation means that there's more labor productivity. Well, there could be more labor productivity because of technology or other advancements. I think just because your wages go up, like, again, it's causation, correlation. Is this all totally connected, or are they making stretches to say, well, look, in this situation, here's what's happened in the past, and this is why we think it's going to be positive for you. But it's really, they're always going to tell you to invest. Hey, the market's down, buy it on sale. The market's flat. Hey, you never know when it's going to go up. The market's going up. You got to get in as soon as possible. They like to trigger that kind of fear and greed in the emotion of the investor. And then 10, it says the market's headed into historically strong return quarters. This seems even crazier. Oh, the second and fourth quarters have historically been periods of strong returns for stocks. Really? That's like, this seems like a stretch with a lot of these things where they're just, okay, analysts say, if they were so accurate, then wouldn't they always have consistent returns based upon these different indicators? This is guesswork, even if it's an educated guess sometimes. And when I was in college, I took an econometrics class, and then you would have to predict what's happening and I was trying to see if I could predict what's going on in the market. But there's so many factors and so many curveballs that come in that even if everything seems to make sense, like in 2020, it's a curveball when there's something called quantitative easing with the Fed just printing money and adding it to the money supply that throws the entire model off. So this article is saying, hey, it's all going to be good, and here's 10 reasons why, so go ahead and invest. I don't think any of these arguments truly hold up. And the most important thing is for you to discover your investor DNA. Invest in things that you know, protect the downside, increase your skill sets and your ability to add value and make more money. Get more clear about how you can plug your financial leaks and keep more of what you make. Focus more on cash flow. Maybe stocks are not the best thing that's for you, even though we are taught that stocks are synonymous with investing. I have no money in the stock market. It's not what I'm skilled at. It's not what I love to do. And I don't trust most of these fund managers because they don't outperform a lot of times what the index funds do over time. So the fees often aren't worth it. So do you have high loans, high interest rate loans? Have you, built up your business properly? If you own a business, start to think about investing in yourself, discovering your investor DNA, and start to ask more critical questions like we just did here to discern truth from falsehood when it comes to your finances. Hey, thanks for watching. I appreciate it. And if you're enjoying these videos, well, there's good news. More where that came from. So go ahead and click through and watch the next video now.